Let's go over an option trading strategy for a bullish investor. That would be one that thinks that a particular stock is going to go up. But what if you think that the stock price will go up, but maybe it's not going to rise that much? Well, you could look into a bull call spread strategy, and we'll dive right into how that works, how it limits your risk. But first, let's go over the basics of a call option. A call option is a financial contract that gives the buyer the right, but not the obligation, to purchase an underlying asset at a predetermined price, we'll call it the strike price, on or before a specific date, which we'll call the expiration date. Now, why might we want to buy a call option, and what would our possible outcomes be in terms of profitability if we did so? Let's take a look. In this example, we will buy or go long a call option with the strike price of $50. This means that we have the right but not the obligation to buy the underlying stock from someone else for $50. So we will have increased profitability if the stock price goes up, because we would like to buy something that is more valuable for a lower price. But in order to get the option to do this, we have to pay a premium right up front of $5. So let's walk through on this table a couple of examples of how much money we'll make at the end of the life of this option based on different underlying stock prices. Now, if we just take a simple example of when the stock price is $0, that means that we will not exercise this option because the stock price does not exceed the strike price. So in the column that I've labeled max of stock price minus strike price or 0, we're just going to put $0 because we won't expire option. However, we did pay a premium of $5 to get the rights to this option in the first place. So our profit at the end of the life of this option is that we have actually lost $5. And it's the same scenario if the stock price is 50, because we would not exercise this option. We're not going to buy something for 50 that's only worth 50. There'd be no point in doing this exchange. So we've lost 5 again. However, when the stock price is 53, we are going to exercise the option because we want to buy something that's worth $53 for only $50. That has a value to us of $3. However, we still had to pay $5 to get the right, and that was the premium for this option, and our total profit is that we've lost $2. Where we break even is when the stock price is $55, because that means we can buy something for $50 that's worth $55, that's worth a $5 value to us, but it just perfectly offsets the $5 of initial upfront cost that we paid at the beginning of the life of the option, and our profit 0. And then now we can see that for every single dollar that the stock price increases after $55, we're going to have $1 additional gain in profit. And our potential profit is infinite. Now, with those basics out of the way, let's dive into what is a bull call spread. This is an options trading strategy that involves simultaneously buying a call option with a lower strike price and selling a call option with a higher strike price. Both options will need to have the same underlying asset or stock and the same expiration date. Now, who would be interested in a bull call spread? It would be someone who is interested in lowering their risk profile because it has limited risk, but at the expense of having limited profit potential. This is for someone with a moderately bullish outlook. So you think the price of a stock is going to rise, but maybe not by all that much. Let's get into how you would go about the process of entering into a bull call spread. The first step is to purchase or go long on a call with a lower strike price. We'll stick with the same example that we discussed earlier in this video. We're going to assume that we're buying a call option with a strike price of $50, and we're going to pay $5 for the right to do so. So a $5 premium. Profit profile in the graph on the right is exactly the same as the long call that we discussed a few minutes ago. Step 2 is for us to short or sell a call with a higher strike price. That means that we are going to sell the right to someone else to purchase the stock from us at a certain price. In this example, we are going to sell a call with a strike price of $60. When we sell this call, we receive an upfront premium of $3 because we're exposed to risk, so we need to be compensated for that. Now, the payoff profile for this short call is shown by the blue line on the graph on the right. So basically, anywhere where this stock is $60 or less, we are going to have a profit of $3 on this short call. Now, this is because the call would not be exercisable for any value of 60 or less. But then, as the price goes above $60 to 61, now they can exercise that against us for a profit of $1. We still had our $3 gain, so we're really only up $2 at a price of 61. However, for every single dollar that the stock price increases beyond that point, we lose an additional dollar. Our downside is unlimited. We could lose an infinite amount of money on just this short call alone. However, when we pair it with the long call, that is when we have the bull call spread. Now let's look at that payoff. The bull call spread is simply just the combination of both of these different option positions. Now you can see on the table to the bottom left, I have added another column called the bull call spread payoff. The bull call spread payoff for any given stock price is just the combination of the profit or loss from the long 50 call and our profit or loss from the short 60 call at that stock price. And what is this telling us? We can see the payoff on the graph to the right. It shows us that at any given stock price, it doesn't matter how low the stock price goes, the most money we can ever lose is just $2. So we have limited downside or limited risk. However, no matter how high the stock price goes, the most money we can ever gain is just $8. So we have limited upside. So the reason that this functions the way it does is that as that stock price increases, for every dollar that we gain on our long call, we also lose $1 on our short call once we're past $60. So we get this line going perfectly straight to the right once we hit $60. Now, this begs the question, hey, if I'm bullish, why would I do a bull call spread rather than just buying the call option, right? Why do I need to take the extra step and do the shorting the higher exercise price call? Well, it's because for all values under, I believe, $63, the bull call spread will actually outperform the just longing the single call. So if you think that the stock price is going to rise, let's say the stock price is $55, you think it might rise, but you don't think it's going to rise all that much before the expiration of these options, you would actually prefer the bull call spread because you don't really even think that the price is ever going to rise beyond $63 anyways. And you can see that up to that point, the green line outperforms the blue line at all of those prices. Thank you for watching this video, and check out RyanO'ConnellFinance.com for one-on-one tutoring with me, and feel free to watch any of my other option videos which you will see here or here.